Climate change is one of the biggest threats that modern humans face. With time and evidence, it's known that some degree of catastrophic climate change is unavoidable. This means increased climate risks associated with it. The extreme weather events and variability in rainfall and temperature are an accompanying challenge. But who is most affected by it?
Some of the people most vulnerable to climate change as well as increased climate risk are rural farmers because they depend on rainfall for their agriculture. And these are also some of the very poor farmers with limited resources to cope with this risk on their own. So, ways in which this population can adapt to climate change, understanding those ways and helping them is very, very important.
In trying to help rural households with climate adaptation, this study poses two important questions. How do farmers plan financial security during times of climate crisis? And more importantly, how well can financial inclusion help them sustain themselves in the future? The first step towards extending help is to understand how deep-rooted the problem lies in India. The study used survey data from 1,100 households from 30 villages in India over 5 years. The data set has information such as what crop farmers grow, how they hold their assets, whether they have faced climate shocks, and more. 59% of households experienced climate shocks in at least one of the 5 years, and 13% faced them in more than 2 years, indicating significant vulnerability.
We complement this data using data on climate variability at each village level using data from IMD. And using this historical patterns, we calculate variation in temperature and variation in rainfall at that particular village. So this is our primary measure of climate risk.
While assessing their climate risk, variations in rainfall are given a special focus, as these farmers rely on rain for agriculture. The assessment helps understand how climate risk differs across the villages in the sample.
Now, one way in which they can protect themselves is by keeping a greater fraction in what we can say liquid assets in response to this risk. Right? What are liquid assets? Cash, jewelry, financial instruments, something that they can use very quickly. Of course, liquid assets is a great buffer, but it also prevents using this fraction in more productive ways, say buying a tractor or using better seeds, more weather resistant seeds, and so on. So in this study, we are looking at how financial inclusion will interact with these households' need to keep a liquid buffer.
These households primarily rely on their savings when they face an adverse climate event. When they go for external aid during times of climate shock, their most reliable source of assistance is from kin and relatives, followed by friends, village communities, money lenders, and then banks. So, there isn't a lot of financial inclusion among this population. For this study, a household is said to be financially included if they have a bank account or if bank is in their top 3 choices. This brings us to our main question. How do households behave when they face climate risks, and how does their behavior change the financial inclusion?
Households in these villages with greater climate risk do hold a larger fraction in liquid assets. But if the household can rely on bank, they then hold less fraction in liquid assets. And again, this is important because the less need they have to hold assets as a liquid buffer, the more resources they have available for investing in whatever technologies that they need.
The study concludes that financial inclusion helps provide relief from holding unproductive liquid assets as safety buffer, and thus benefits households in using their funds and resources productively. The implications of this study are both for adaptation to climate change and discussions about financial inclusion. Currently, strategies for climate change adaptation are based on a top-down approach, which includes technological innovations, financial subsidies, seed distribution, etc. But the effectiveness of these solutions has to evolve for the country at large, considering variation in local conditions.
The strategies that will work at a particular location, even for a particular household, are very different. And so that is where the top-down approaches have their limitation, right? What works in one area will not work in other areas. The advantage of freeing resources at the household level is that they can make the decisions that is best for themselves for adaptation to climate change. And so one implication of the study for policy discussions about adaptation is that including financial inclusion as a complement to other strategies of adaptation is going to be very relevant.